This is Good Business New York, and we are an online social media network here in New York. We're he's making me nervous with that camera. An online news journal for social entrepreneurship and small sustainable business and everything good about business, like how business can make the world better, which is why I have these two fantastic people here today. There's so much to talk about. We only wanted the two of them because they are so awesome. I will confess, full disclosure, I like them both personally. I've known Amy for a few years, and the more I know her, the more I love her. We're very good friends now. And we work on projects together because she's smart and talented, and it helps me look smarter and more talented. And Sang is adorable. I just love him. And as cute as he is, he's actually amazingly sharp. We were listening to him the other day. He's one of those math wizards, which Shane is also, can create algorithms and understands financial engineering. And somehow, working on Wall Street, he decided to, I'll let him tell the story. We'll let them both introduce themselves. But he has this platform called Return on Change. He worked on Wall Street. Now he's creating a platform for crowdfunding investing, equity crowdfunding investing, that is all about making the world better and supporting social entrepreneurship. Amy is an award-winning writer, writes often for the New York Times. She's actually writing quite often about crowdfunding for the Times. Lately, she's become one of the foremost experts in the United States and the author of Locavesting, Revolution in Local Investing and How to Profit from It. So thanks both for being here.
Thank you. And first of all, I want to say I don't think either of us pay her, but maybe we should.
Yeah, and she looks gorgeous. She said she didn't like her hair, though.
It's really hammered out if it's looking crazy to those outside of New York. But no, really, thank you for that really nice and probably, I know, but flattering intro. And love you too. So as you've heard, yeah, I'm a longtime journalist, also the author of a book called Locavesting, which clearly is a play on the locavore concept. So we eat local, we buy local. My book was about investing local. And I actually wrote it, well, it came out in the spring of 2011, and I talked about a lot of different ways that people and communities are finding ways to invest locally. So everything from community development loan funds to local investing networks to direct public offerings, things like slow money. And I did write about crowdfunding, but the Jobs Act had not been passed yet. So clearly that is the very big news these days. I think it's a game changer for local investing. It's something I'm spending a lot of time on lately. And I'm looking forward to talking more about that.
Yeah, great, thank you. And one of the reasons we chose both these guests is because they are experts on the Jobs Act, and that's what we're going to talk about today, because the new ruling came down, and Shane knows a lot about it. He wrote an article about it, you wrote about it, I wrote about it on Goodbees. So we're going to share today all the information that there is to know about the new ruling. The two of them have kind of waded through a large portion of the 500 or 600 pages of that ruling, but they're going to interpret it for us. So Sang is actually in the trenches, actually has an equity crowdfunding platform that he is waiting for the ruling on. He's like kind of in limbo. The two of them, they maybe don't know that, but you've been in the same conferences, right? Speaking at the same conferences. They're both experts and speakers on the subject all over the country. So, Sang, tell me a little bit about yourself that I didn't cover.
Sure. Well, you speak way too highly of me. My name is Sang, though, that is true. And I am the CEO and founder of a company called Return on Change, which is, in fact, an online investment platform for high-impact startups to basically raise money for early-stage businesses and entrepreneurs that have a social mission embedded into their DNA. And the thesis behind that was, like Monika mentioned, I was working on Wall Street, but after the crisis and with large financial products, it was impossible to instigate innovation. It was impossible to fight for the social good, to fight for things that people actually cared about, which is why I entered the field when before crowdfunding was even a hot topic. It was so clear to me that everyone should have a say in the kind of companies that actually grow and proliferate. So we founded Return on Change, and now we're actively working with startup companies in social enterprise, medicine, education, to connect them with the investors that are motivated in funding companies like this. And like Monika mentioned, we're excited to get non-accredited investors involved as well. So hopefully we'll be working really, really hard in getting the right rules in place for the next 6 to 7 months.
Okay, so that brings us to the subject, and thank you for doing that. And we're going to kind of dip back and forth into your backgrounds and everything, because one of the things about social entrepreneurship is you really have to have a passion to change the world. It's not the most lucrative thing in the world. We all know that. We could be doing a lot of other things. And why do we choose this? I mean, like, this whole, the equity crowdfunding, like the Jobs Act, so we'll take one at a time. I'll start with you, Amy. What does this mean for the, quote, little guy, the unaccredited investor? What is an unaccredited investor, and how, how are they locked out of the system, and how does this put them back in?
Sure. That's a lot of questions there, but let me take the little guy and how he's locked out of the system, because he very much is. And I think, it's interesting that Sang mentioned the financial crisis as kind of a catalyst for his own, decision to start Return on Change. And it similarly, prompted me to write the book, because I think what the financial crisis did was kind of lay bare the failings of the financial industry. And, here we had these big banks take us to the brink of economic collapse, and then they just kind of skated away and left a really big mess in their wake. And I think a lot of people were looking for alternatives to Wall Street, and now I think with crowdfunding we have one. But what's happened over the past 2 or 3 decades, I think, in the financial industry is that the small and medium-sized businesses, regional growth companies have been falling through the cracks. Banks aren't lending like they used to for a number of reasons. Consolidation, now they're somewhat constrained as well in the types of loans they can make. And the financial crisis really just exacerbated all of these trends that were already happening, and really put a crimp on capital raising for entrepreneurs and small businesses. So I think the timing could not be better here. And what I love about crowdfunding it's really democratizing finance, and it's not just opening up more capital for deserving small businesses and entrepreneurs that create jobs and do innovative, wonderful things, but it's also creating opportunity for investors who tend to get screwed in the financial system as well. And the stock market has really become, the realm of high-frequency traders, and people like that are making, well, stock market is up right now, but it can go down again. And my point is that it's not really, it's kind of rigged against the small guys. So I see crowdfunding addressing these failings in a lot of ways.
So I just had a quick question that came through direct tweet to me, because they're watching the stream, and they said, but how is it really rigged? Because I don't think a lot of people really understand that. You mentioned that it was rigged, but like how?
Do you want to? There are a lot of different.
Yeah, I know. I mean, I think we'll both have the same perspective on it. If you go back to the basics, unaccredited investors were never banned from investing in small companies, local companies. Stock exchanges were local. Investing in local businesses, small businesses, was a very normal thing to do until a crisis happened and then we shut it off. Back then, information asymmetry was huge. It was huge. So one guy with a clever idea could actually fleece a lot of investors and get away with it. Today, it's a different day and age. I mean, trying to get away with something in the way we're connected today, it's extremely, extremely difficult. And what you do have, though, is you have information asymmetry in the financial sector, because the banks, the institutional players, will keep the wealth of knowledge with themselves, and what they'll be able to do is generate wealth within that community by charging fees or getting the best of the best deals or whatever it may be. If you look at even the today's startup, a lot of people will disagree about this, but if you look at the startup's life cycle today, when a VC backs at very early stage, and then they scale it a little bit, then you start pumping capital into it, scale it, even when they're losing money, and then you IPO. The moment you hit the first dollar in the black, you IPO, and then you dump it into the
Okay,
retail market,
I'm going
right?
to talk about that a little.
Yeah, and I'd
Yeah.
like to add to
Yeah.
that too, because not, to follow on onto this, why do we make that comment that the financial system is rigged for the little guy? I mean, if you look at, so our securities laws said that if you were wealthy, you could invest in anything you wanted. If you were not, with just a very few exceptions, you were pretty much confined to the public markets. And that actually worked pretty well when the public markets were a true engine for growth. But what's happened over, again, the last 2 or 3 decades is that the action has shifted from the public markets to the private end of things. So when Microsoft went public, when Walmart went public, they went public here and their growth went like that. So the public, public investors, the little guy, shared in that growth. But today, it's more like Facebook. All the growth takes place here, like Sang was saying, and then it goes public and it's either down or flat. So the action, the growth, the appreciation, the wealth creation is all on the private side. So what we're saying is that right now, the little guy is cut out from that. With crowdfunding, he gets a chance to play in that.
So I want to talk about that a little bit because there's a couple of things that go on in my mind about it. And this is one of my, when we're talking about, we had a question come in, like, define crowdfunding. So I'll just define that really quickly. We're talking about, right here, equity crowdfunding, investing your money into a small business and or any entrepreneur or any startup. Right now, you are blocked from doing that unless your net income is $200,000 or more, and your net worth, not including your primary residence, is $1 million or more. So it's kind of geared. This is what we're thinking. This is why it's called Democracy of Finance, the Jobs Act, geared towards the 1%, or in this case, maybe the 2%. And it leaves out everybody whose incomes aren't $200,000 and over. And in New York, $200,000 actually is, you're struggling. You're struggling with that private school and the country club. Anyway, it's a little different. New York, 200,000 is different in New York than it is in
absolutely.
Very true.
Absolutely.
So what we're talking about here is democratizing the system in terms of everybody investing. So this is what I have questions about this, and I've never had an answer on it. So we have a banker, and we have somebody who's well researched in this subject and knows it thoroughly, both of you, from different ends. And I really want to ask you this. If I want to invest in the stock market, and I want to put my money in Enron, and by the way, I did, way back when. I didn't, but my accountant did. When I was on Wall Street, put my money into Lehman Brothers, put my money into Bear Stearns, put my money into Goldman Sachs, because these were our clients from the firm that I worked at. I worked as a recruiter for the Wall Street markets, for the mortgage-backed securities market. A whole nother story. Let's not even talk about it. But, and I lost a fortune, literally. Lost a fortune the first time when Enron went down. Was never even invested in the stock market before in my life, and apparently had thousands of shares I didn't even know about, gone. Then the same thing with Lehman Brothers. I was a little supposedly wiser, but they were a client, and completely wiped out on that one. And I know people who were in the firm who were like part of the old firm. I knew somebody that was like 67 years old and he lost his entire retirement from it. And like secretaries at Lehman Brothers that were wiped out, never got anything back. Even the traders. And there's a lot of people there that were not part of this real estate structure, the mortgage structure. So my question is, nobody protected me from investing in Enron or WorldCom or IndyMac or Washington Mutual, Lehman Brothers, or any of the ones that went belly up. So why are we afraid of defending the little guy now for investing in the business that I know down the street, or the person that I know, like Sang, if I want to invest in his company? Why can't I do that?
I can start with that. I think there's sort of a patronizing attitude out there about the little investor, the small investor, the retail investor. Well, they might be a financial journalist that, just isn't at the $200,000 threshold.
They should pay you.
So who's more sophisticated, Snooki, or or that financial journalist?
I did my makeup like her.
Well, you don't have the little bump.
I would have a little hairpiece, but I didn't.
So, my point is, this accredited investor concept is a little bit flawed, and so people are actually talking about, well, maybe there should be a test. You take a driving test before you get your driver's license, because if you're wealthy or not wealthy, doesn't mean you know how to drive. And it's kind of same with investing. Just because you have a lot of money doesn't mean. I mean, we've seen a lot of wealthy, sophisticated, heads of major financial institutions not even know what's going on in their own companies, and get us into this big mess from 4 years ago. So I kind of take issue with that accredited investor concept, but I do understand the concern here, and the SEC, by the way, has a mandate to protect investors as well as to promote capital formation.
Well, how well are they doing on that? That's my question.
Yeah, they're trying. So, yeah, I think, and I want to let Sang answer, but I'd love to come back because I have a whole, I think there's a lot of logic and in an argument that can make the case that a local company, a company that is much less risky actually than some of these big international conglomerates where there's no way in hell you could understand them even after reading through their
the transparency is much more much clearer on that. By the way, you're blocking Amy just a little bit on camera.
Oh.
And so Sang, because she's big and you're tiny. So Sang, what do you think about that? I mean, like, you have a view on that?
I think there's multiple facets to the concern. I mean, to expand on the accredited investor definition that Amy was talking about as well. I mean, if you go to the actual regulators, they'll say that it's not a test of sophistication. It's a test that you can bear the risk of loss, which is A, not true, because you made 200 grand doesn't mean you can lose more money than other people, and B, they educated people.
You might live in New York and might have kids in private school. I mean, how are you going to do that?
And B, they educated people to think that it's a sophistication test. So there are 3 of the 5 criteria, I guess, that do count as sophistication tests because you work for a bank or you work for a money manager, et cetera, et cetera. To your point about why didn't they protect the smaller guy in these original investments that did cause the financial crisis, and we were there for Enron too because I worked in energy. It's the same thing, same way they're trying to protect the investors today. Disclose, disclose, disclose. And what they can do now is they can look at you with a straight face and say, we disclosed the risk, which is ridiculous. It's ridiculous because they didn't disclose anything because it's too complicated for you to understand. I mean, the public market, what the basic threshold is, enough information has been disclosed and enough professionals have looked at it that it's an investment that an everyday person should be able to look at.
So I have a question on this level, okay? Because I did work in the markets, and I was there during the mortgage-backed securities markets. And I remember, the effect that Wall Street has, as we know. And I'm talking about Wall Street. I'm talking about, in this case, Wall Street is huge. I'm not talking about the stock market. I'm talking about the bond markets, which are really secretive, and they're behind the scenes. That's where I worked. There were people moving, they were called block traders. They were moving billions and billions of dollars worth of mortgages pooled together, behind the scenes that nobody heard about. I mean, we're talking 50 billion, we're talking 30 billion, behind the scenes. Me, as a private investor making under $200,000 a year as a non-accredited investor, and if you invest $10,000 or $5,000, I'm going to invest in Amy's business, or in your business, or in Shane's business. I am not moving block trading. I'm not block trading billions of dollars where I can damage an entire ecosystem, entire economic system in like overnight, which is literally what happened. What I remember was that these so-called sophisticated investors, and I wrote a book about it called Conversations with Wall Street, and they admitted to me we didn't know what was going on. We were siloed. We didn't see everything, and they don't have time to see everything. They're looking on the screen. They got to make the trades very quickly. I think that the risk that's posed on the side of the big institutional accounts is far greater than on the small unaccredited retail accounts. I mean, and I feel personally as an American, I feel like, really get out of my business. If I want to donate, if I want to invest $1,000, $5,000, $20,000, whatever I have, it's really none of your business. Okay, if I want to do that, you're not paying for it. You're not going to pay when I lose in the stock market, and you're not going to pay when I lose in your business. And so the risk, if you talk about dispersed risk, it's really dispersed, because we're talking about investing in your small firm. How many people are going to invest in your small firm? Right. Even if you had 200 or 1,000, it's not as much as a block trader in Goldman Sachs. So, I mean, I don't get it. To me, it's like anti-democratic, and it's definitely rigged in terms of the 1% to 2% at the top, you know, that they can, quote unquote, afford it. Who's going to tell you what you can afford? I mean, I could go buy a Mercedes now if I wanted to. I mean, I don't know. But if I could afford it, who's going to tell me I can't? I mean, people are going in debt every day. They ratchet up their credit cards, you know, and
nobody's stopping you from ratcheting up your credit cards or walking into a casino and losing your entire life savings. So, I mean, this is
more of a risk, actually.
Yeah, and this is the thing about the Jobs Act, that it makes me crazy when I hear people talking about this risk and protecting the poor little retail investor. They're capped. They're capped. If you don't make $100,000, the most you can invest and therefore lose is $2,000. You're not going to lose the farm on that. Sorry. And yet you might actually have a very good investment there. And maybe it's besides the point to you. You just really want to invest in this because you believe in it. So I agree with you. I mean, you know, let's stop the paternalistic attitude and just, you know, let people invest within a reasonable parameter.
In all fairness, too, and this all applies to, I'll ask this question the same. I mean, just create.
One second. Before we go any deeper into that, I want to get some clarification about a couple of things. First off, we're talking about something, and I'm getting, like, I've gotten a stream of questions early on, and we still haven't addressed it. We're still talking about the threat that we perceive there being for people investing money and then losing that money, right? Or the possibility of risk in that space. We're still kind of stuck in that space. Well, what changed with this Title III? I mean, that's what this whole conversation is around. Like, what happened that really made it so different, and did it even move the bar at all? I mean, I think we got tons of questions in that space. People reading articles saying it sounds like nothing changed, and then other people saying it sounds like things are totally so much better now for small business. Which one is it?
Well, let's start out with the two titles. Let's start out with Title II and Title III. Okay, can you tell us what Title II was? That was like in the summer.
Well,
right? Tell us what the Jobs Act is.
I'll quickly summarize Title II because that's not what we want to talk about right now, but it's basically being permitted to advertise the fact that you're raising money to accredited investors. Well, actually, you can tell anybody, but you can only take money from accredited investors. If you've ever told anybody that you're raising money without registering your securities, you've technically broken the law. And that's what basically changed, was that now you can go on social media, you can do outreach and say, I'm raising money, and hopefully you can reach a broader network of investors that will be able to participate in your offering.
Was there ever a time, either one of you, that we could do this? Was this a prohibition?
Yeah,
I mean, was this like a Great Depression law that came in?
It was, and I think Sang was talking about that earlier, where you know, it used to be investing was pretty much local by nature, and you could in fact walk into a company and buy a share of stock, or you know, it was, you know, people who lived in a place that built local industries. They were the natural people to invest. The local merchants invested. This is how things worked. I mean, that's not to say there was not, you know, long-term, you know, long-distance investing as well, but very much of it was local. So what happened was in the 1930s, during the Great Depression, we had our securities laws that we still live with today were put into place. So that's 80 years ago, when the new technology of the moment was the telephone, like the landline. You know, we used ticker tape. This is how long ago this was. So what the Jobs Act does, and the crowdfunding provision in particular, is kind of bring those securities laws up to date for the internet age, because as Sang was saying earlier, what the SEC is concerned about is disclosure. They want to make sure that everyone, all the investors, know their risks. Well, you know, in the old days, you know, if you were a widow in Kansas and somebody, you know, came out, some slick East Coast salesman, you know, selling you a hot land deal.
You had no idea.
You had no idea. You had to get on a train to go check it out. But today, you know, like all of that is not only available on the internet, but you have, the power of the crowd and social networks where, people can put their collective power together, or there are just there's social relationships, so people could say, well, I know that person, or you know what, I live around there, or I'm in that industry, you've never heard of that person, that smells funny. So there's a lot more opportunity to reveal and expose the kind of information that investors need, and that's kind of what
So that was Title 2.
Yeah.
Title 3.
Well, that was kind of what I was talking about.
Okay, so that
kind
drove
of
into
for
Title
both,
3.
yeah.
Well,
Okay.
Title 3 has been, Title 3, correct me if I'm wrong, Title 3 is, and Amy, you just were talking to me about this, is 600 pages of a new interpretation of how we're going to protect this little guy.
Yep.
And this affects both of you, because now, in order to create a crowdfunding portal, apparently you need $400,000 worth of investment to do that, and in order to put your business on there for investment, you need $100,000. You were telling me. How does that work?
Okay. And I just want to make sure we're clear, like before I answer that, crystal clear on what we're talking about here. So in case there's any confusion, there are different types of crowdfunding, and I think people get confused. So we have donation and reward sites like Kickstarter and Indiegogo and Rocket Hub. They are not affected at all by securities laws because no one is making a financial return. They're getting a T-shirt or a copy of a product. So securities laws only kick in when there's a financial return. And so I think somebody was asking, well, what changed? Well, everything. I mean, suddenly, for the first time, me as an unaccredited investor, once the laws are finalized, I'll be able to invest in private companies much more easily. Before, it was sort of a gray area, and you had to know someone, have a substantial pre-existing relationship with someone. So I hope that kind of clarifies what's changed here.
You could only, as a quote, little guy, unaccredited investor, invest in the stock market because of its transparency and because
you could only
regulated.
invest in a publicly traded company with very few exceptions, such as somebody was your friend, or you worked in that company and you had a pre-existing relationship.
And as we know, that wasn't so safe. So that's what we were talking about before, right?
And then, so what's happened is the SEC, a year and a half after the Jobs Act was signed into law, has finally come out with its proposed rules. That's the 600-page, tome that we're talking about here, and buried in those 600 pages are a lot of interesting things, and people, I think, have had several days now to digest it. Mm-hmm. And what's clear is that if the laws end up being as they are proposed, it's going to be really, really expensive, this type of crowdfunding, not only for crowdfunding portals like Return on Change, but also for the companies raising money. Their cost of capital is going to be very high because of all the reporting and compliance requirements. So, and I'd love to talk about later, an interesting alternative, which is state crowdfunding.
But towards the end. But I have a question for both of you, but maybe I'll pose this one to Sang. Coming in on Twitter, how, well, it's basically about the alternatives, but how are investors getting involved in your platform? I mean, are they getting involved in your platform? What are the exceptions?
There's tons of investors getting involved in our platform. They do have to be accredited to get involved and to actually invest in the company.
How do you become accredited?
The accredited standard currently as it stands is a self-representation, which basically means I am an accredited investor. But if you are using Title II, which we just talked about, which is general solicitation, the investors need to be accredited by much more stringent standards than saying, yes, I am an accredited investor. That used to be good enough because the market was so private. Mm-hmm. Now that it's opened up a little bit more to the public, what the SEC has said, if you want to advertise, you can. Right. But when they give you money, you have to be really sure that they are an accredited investor. So some of the guidelines they set forth, which are very invasive, are getting tax returns, getting opinions from lawyers, getting opinions from CPAs. Although they did offer up the third-party verification method, which ultimately ends up being a soft credit check. where the program basically pings the IRS and Experian to see how much money you've made. It never pulls down the report,
Right.
but it checks that you made more than $200,000 or you're worth more than $1 million.
Oh, okay. We have
So
to
there's
take a
some-
little break for our Halloween costumes. So
Okay.
we just have to take one little break for
Yeah.
Halloween costume. Do you guys know what I am? What my costume is? Can you tell?
I can't.
Obviously, sports fans don't say anything, Mark. It's a Yankees hat.
But it's red.
Yeah,
Yes,
that
and the
part,
Boston
but-
Red Sox won the World Series yesterday. I am wearing black because I'm in mourning.
Oh, okay, got it.
There you go.
You know what I have to say though, I'm a Yankees fan too, but I'm happy for the Red Sox. I think
I'm happy for the Red Sox too. I love Martha's Vineyard and I love Boston, but I just gotta tease them for sure. Totally. And also I have all my buttons. Like my original costume was going to be, I was going to be retro 2008. I had this Obama hat and I had all the like change that change that happens.
I should have brought my mask.
We can all wear hats.
Where's my hat?
No, Mark, bring the hats over. We'll get the hats. Careful of there's a camera there, though. Yeah, I was going to do change that happens. Yes, we can, and because I have the Obama hat, and then I have my little Hope button. I don't know if you can see it, but it's like Hope. This thing's 5 years old. It looks like it's 50.
Okay, let me see that Hope button again.
Hope button.
Oh, hold it up to the camera.
All right, yeah, there you go.
There it is. Hope.
Got the cleavage. And then I also have the sanity buttons because that's also, these are collector's items from this is Jon Stewart's, his
That's
rally
great.
for sanity in Washington, D.C., which was 2010 or 11. I don't even know what it was.
We swear we're staring at the buttons, yes.
Yes.
And
And the Yankees hat.
Maybe as a group we can be like a social impact hat company. Social impact hat startup.
Awesome.
In
All right.
search of a business model.
Yes. Shane, does all this make sense? I mean, like,
Not as an investor, but
Okay.
as someone who could invest, or who has money to invest, I think about these kinds of things, and immediately after all the stuff that you guys are talking about, I'm going, okay, so that makes it harder for the crowdfunding platform.
crowdfunding. And he hasn't even had
That's a new one.
Crowdfunding. Sorry, I just looked over at you guys. And I hadn't made you big on the camera yet. So.
Can you see yourself?
Yeah, but I'm used to seeing myself. I'm not used to seeing. Yes. All right, so this is good. No, so my question for you is it now easier for me to jump into a crowdfunding environment, or is it not?
Not yet. Not
when-
yet.
when
It's
could that be?
it's very important. I think Amy would agree with me for us to say this because we don't want people overstepping boundaries. It is not legal to crowdfund securities. You cannot raise money on Kickstarter and offer as a perk 10% of your company. You cannot do this because the
Why?
regulations
I
are
want it.
only proposed. I agree, but Amy and I have to read 600 pages and comment on
All
it
right,
first.
so you have some work to do there.
So moving along those lines, from a spectrum of 0, we weren't anywhere close to that, to 100. How far along did Title II take us, and how far along did Title III take us to getting to that 100%?
I think we're really close now. We're really close, so long as the comments that come from the crowd are powerful. We're so close because Title II is already effective. There are some rules they're still sitting on. They're still thinking about it, but I think they've actually put a little bit of responsibility on industry and to the private market and said, you guys do it, but do it well, and then we're going to take that and make the appropriate regulations because they actually let Title II happen without going out with the formal regulations. Title III, we've been holding our breath for October 23rd.
Yeah.
We were holding our breath for that day where they take it out of their drawer and go, surprise, here it is. Unfortunately, 300 pages were questions of 600 pages of regulations. I read all of
That
them.
noise is like a little bit of construction. We're in the stair at Lehigh building. It's very, very upscale. It's very beautiful here.
It is.
And they have good plumbing.
So good we can hear
Part
it.
of our Halloween costume.
I'm turning the gain down a little bit on you guys because
There it
hopefully that didn't get too crazy for you.
Yeah, so, like that's exciting. I mean, I have to give the SEC credit for even going after it because the pressure is.
Well, they had to.
Yeah.
They had to.
Yeah,
They had a
by
deadline?
law. They missed their deadline.
By a year.
By a year.
Yeah. I mean, but in all fairness, they have a lot on their plate. This is the same agency responsible for Dodd-Frank and a
And
zillion
Dodd-Frank
other
is
things.
like, what, 600 pages
Yeah.
too?
And that's another thing I think that actually speaks to the game-changing nature of Title III. Title II was easier to write than Title III. Title III changes everything on its head. You introduce a new asset class, you introduce new intermediaries, you introduce everything basically that's new, which is why the proposed regulations are so long, the questions are so detailed, because they haven't done it in 80 years.
Well, I have a suggestion.
Yeah.
Instead of financial testing for ordinary people, although I really think they should put it into financial literacy, you should start in kindergarten, you should go straight up through high school, and you should be able to get out, read and write, and understand how economics work in a basic way in America. But and certainly mortgages. But I think that they should put every single member of Congress, before they're actually allowed to be part of Congress, before they're sworn in, to actually take economic and financial literacy tests, because I don't think any of them really understand how the markets work, and I don't think they understand how investments work, and they're making these laws. These laws are pretty serious. I mean, even people at the top ends of Wall Street when I was there didn't understand how everything was moving.
Okay, while we're at it, can we make them buy insurance on the open market as well?
Yes, they could buy insurance. And by the way, they should be personally, like the Dodd-Frank Act. Every CEO is responsible for the company. Every lawmaker should be responsible for that law they sign off on. I think. I think we have.
Absolutely. Well, I think I'm going to go on a very short tangent.
Okay,
anecdote.
Go.
Professor Schiller from Yale, the Nobel Prize winner in economics, basically said, if you are a student that wants to be a social entrepreneur with a moral mission, you should go work in finance.
Yes.
Because that's where you can learn where everything kind of works. Because the guys who can manipulate it the best are the ones that have the best insight into actually what's going on. So if you want to fix things, you got to really dive in really deep.
Yeah.
And I think that's Title III is actually doing that. Title III is diving so deep into the basics of what we used to do, which is invest in what you care about and what you need, and instead of just being the consumer on the back end. That I hate to say this because it's the easiest example. If somebody had told you to invest in Facebook, would you have bought that stock when they were at Harvard? Like, that's the real question that you have to ask, right? As a local investor, would you have done that when they said, oh, you need to have a harvard.edu email to operate this website, right? I mean, there were venture capitalists that saw larger value, et cetera, but if somebody said, oh, well, we're doing solar energy in your community, to reduce your carbon footprint, would you invest in that? Probably, right? Yeah. Probably. And the likelihood of that failing, because it's in your community, is much, much lower, like Amy was saying.
So, well, like, all of this just brings up what you were talking about. Before we end today, I want to make sure we know what we can do as individuals, but I want to talk about the alternatives that you've kind of mentioned, Amy. Like, we have 20 minutes here, and I want to start talking about what's the movement behind the scenes that's happening for the alternatives. And the same question for you, Sang. What are some of the alternatives while we're waiting for the Jobs Act to really be enacted?
Yeah, well, some of the things that I wrote about in my book are still very, very relevant. Direct public offerings. It's essentially a form of crowdfunding outside of the Jobs Act that you can do now. You can reach out to your friends, family, customers, social network, and I got to take this thing off. It's a little distracting, but you can do that through the existing 3 exemptions that exist already in the federal securities laws. And not a lot of people know about it, but it's the direct public offering. It's sort of coming back in vogue, but the most famous example is Ben & Jerry's in 1984 raised, I always forget, like $70,000 or so dollars to, this was seed capital to get out of the garage that they were making ice cream in and actually really expand. So they did what's called an intrastate offering. So they sold shares to, you had to be a resident of Vermont to buy them, and they actually, advertised right on the ice cream carton. They put a little sticker that said, "Get a scoop of the action," and hundreds and thousands of people did, and they did really well because Ben & Jerry's went public the next year, and it was really a win-win for everyone. So
is that a big legal, complicated process?
It's a little more complicated than crowdfunding. The estimates are that it would cost you about $25,000 minimum in accounting fees and legal fees,
Right.
because even though it is direct, and some people have done them without a lawyer, it's probably advisable to have a lawyer.
So you have some of those people in your book with investing, right?
Yeah.
Some of the experts on that.
Yeah, so there are things like that, and again, slow money, local investing opportunity networks, all sorts of things like that. But I've been really fascinated watching what's happening on the state level with intrastate crowdfunding. So far, 2 states have passed laws. Actually, they were done administratively, not legislatively, but Kansas and Georgia have made it possible for any business based in their state to raise money from any person based in that state.
Wow.
Simple as that. And there's
Wow.
a one-page form that the company has to fill out, and the costs are so much lower than the Jobs Act. So Jobs Act style crowdfunding. So now you see at least a half a dozen other states are doing the same. Michigan just had their crowdfunding legislation pass the first hurdle in their state house. Wisconsin's is waiting for the governor to sign it. There are efforts in New Jersey, North Carolina, Washington State.
Wow.
Even I heard from someone who's trying to start an initiative here in New York for a New York State
So which
Jobs
ones are
Act.
currently active right now? Which ones?
Georgia and Kansas. If you live in those states, you can, if you're an entrepreneur, you can raise money from anybody who is based in that state. And in fact, it doesn't even have to be over a crowdfunding portal.
Yeah.
It can be completely offline or on your own website, however you want to do it.
Really? So
Yeah.
save moving, where do we go? I mean, actually, is it kind of like credit cards? We could go incorporate in Georgia and do it there, but they have to be
No,
living in-
you really, they want to make sure that you're really based there.
Yeah. Well, so how does this affect you, Sang? I mean, you have an equity crowdfunding platform. Just very quickly, tell us what the action is on your site since Title II came in.
Right.
You had an event here right after
Yeah.
that, here at CSI Center for
Yeah.
Social Innovation in New York, which is where we're coming to you live. It was pretty fascinating and
Yeah.
really interesting entrepreneurs.
Yeah.
So how is this affecting you? How is Title II affecting you, and in what way specifically, and how is Title III affecting your platform?
Title II, definitely we saw a huge uptick in investor interest, generally speaking. Tons of them are unaccredited investors because now they can actually view offerings, they can look at companies and say, wow, this is kind of cool. When can I get involved?
Yeah.
I'm like, no, you can't, I'm sorry.
Not yet.
But, Title III, October 23rd, I mean, as much as 6 to 7 months sounds like a long time, it's really not in creating a market like this. And, the alternatives are fantastic. Like Amy was saying, if it applies to you, you should definitely try to leverage it.
What are you talking about, 6 to 7 months? That's when the...
From the October 23rd until it hits the Federal Register, conservatively, let's call it.
So something's going to happen in 6 months. And you have a
Hopefully
spare
we'll-
$400,000 cash, you can create a crowdfunding portal, and if you have $100,000 in
Right.
cash, you can... If you're like a half unaccredited investor, you can just...
But just to be clear on the timeline,
Yeah.
there's a 90-day comment period.
Right.
So if you have constructive comments,
Yeah.
by all means,
Yes.
put them out there.
How do you do that?
There's a link on the website, and I wish we brought it on the
Well,
SEC
we'll-
website.
It's on
have
the
it on
website. And
that.
what we're also
Okay,
going to do, so people don't have to go through the 600 pages, is we've actually started summarizing the questions that are actually relevant for entrepreneurs.
Okay.
Some of them are just related to the intermediaries and how they file and stuff like that, which is completely insignificant for the entrepreneurs that are going to be using it.
Right.
So the points that are important for entrepreneurs, we're actually going to send out the survey publicly to say, if you have comments, send it to us, and we'll make sure that we include that as our appendix to our commentary.
How can we start with both of you? How can we start forming like kind of a shareholder, unaccredited shareholder coalition? I mean, why don't we start one and like start here today? And like join forces in this because it's all about numbers, right? So if we have numbers of people and eyeballs on this, Twitter never had any profits, and apparently still doesn't, but they never had any profits, but they had millions of users, right? Mm-hmm. So the crowd really makes a difference, right?
Yeah. Well, it's interesting because the one organization that you see quoted in all the news articles that's representing consumers is always rabidly anti-crowdfunding, and it's going to open the doors to fraud, and it's horrible.
I've seen those, yeah.
It's the
Consumer Federation of America.
Oh, yeah. Right. It's a lobbying group. It's a name for an actual banking lobbying group. You should know that, right?
Is it really? Yeah.
Oh, wait, CFA? Are you talking about CFA?
Yeah.
Oh, no, actually, they're really good. But they're a little paranoid.
Yeah.
And that's Elizabeth Warren's thing.
Yeah.
There's a fine line between that paranoia as a former banker, as a financial researcher and writer, and myself with my own background here. There's a fine, and entrepreneurs, all three of us. There's a fine line between mitigating risk and completely stalling.
And I think they're as great of a group it is in protecting investors, the line between fraud and failure is really wide. Yeah. But in the startup world, people think it's very thin, which is the problem. That if you fail because you didn't tell me you were doing something, that's the equivalent of fraud, which is not true. The nature of a startup business is that they have to be flexible, they have to do things, and if it fails, it fails. But I think there's a little bit of a misconception when there's a lot of concern over fraud, they're going to lose their money, the business is not going to do what they said they were going to do. Mm-hmm. That's startup business. That's industry standard that they don't do what they said they were going to do.
Well, I want to say that smaller businesses, first of all, to your point before, have more transparency. You could see who they are, and I believe in the financial statements. Hey, why not? Yeah. Why shouldn't you be accountable?
But right? There's two things here. Startups, which are startups, they're sort of unknown, and they're, for that reason, a little bit more speculative. You're really kind of taking, a little bit more of a risk on them. But you can also engage in crowdfunding with established businesses that have a track record. And the other point that seems to get lost in a lot of this debate is that we're not just talking about equity, even though we call it equity crowdfunding. It's any securities. So a company could issue equity shares, but they could also issue debt, right, loans, or a revenue sharing agreement, which is a really great arrangement both for the business and the investor.
Can you do that legally now? Can you issue debt?
When crowdfunding becomes legal, you'll be able to do all of that all at once, but again, it's not going to happen until sometime in 2014, at least 6 months from now. I think there's less risk in that model where you have established businesses and some form of debt or revenue sharing, because they're established, they have a track record that speaks for itself, and they also have the cash flow, so they can pay investors on a monthly basis, and you don't have to wait 5 or 10 years for the startup to go public or get acquired. So there's no, you don't have to wait for that exit. You're getting paid back as an investor every month. And there's a really successful example of this in the UK called Funding Circle, and they've done I don't know the numbers now, but they've lent to thousands of businesses, and investors typically get a net return of 6 to 7%, and they've had very few.
A net return of 6 to 7%.
Yeah, like after 6 to 7%.
Oh, 6 to 7. I'm like, wow,
6%, 6% to 7% after fees. Yeah. And they've had, I believe, if it's still the case, zero fraud and just very few failures, tiny compared to the amount of loans they've done.
I want to point out that these companies that we're talking about are so small. You're talking about $1 million or under revenues, or even $100,000 or under revenues, or $250,000 under revenues. That Wall Street cannot be interested in them. Their investments are like minimum 200 million and up. So, we're talking about an entire market that exists under the, say, 25 million, 50 million less market that is out there. I mean, actually, there's a tremendous amount. I was doing research recently on how many companies there are with $1 million in revenues and under. I mean, and it's apparently like 56% of the businesses out there are $1 million and under. These are mom and pops, these are small family businesses or sole entrepreneurs, and they don't have this huge revenue. So Wall Street is never going to touch them. And I think one of the things that we're looking at is like how ordinary people have a very practical sense of investing. Okay, you know, we're all spenders in America. We're a little materialistic on that credit side, and we really hit the skids in 2008 from that frenzy. But we know, oh, okay, well, if I invest in Sang's platform, and I want to invest as an investor in a startup, one of your startups, you said just thank you notes, right? It's called, what is it called?
Thankster.
Thankster. Okay, it sends thank you notes out to your whole company, and it will do it in a personalized way. And if I think, well, that's really cool, okay, they're going to charge companies to do this, and that's a really great product, I want to be able to have the option to do that. And if that makes sense to me as an ordinary person, then I'm going to do that.
Right.
You know, as opposed to when people were investing in, say, credit default swaps, which you both know what they are, probably most people don't, which are like these quasi-insurance products on mortgage-backed securities that even the market didn't know what they were. You know, I think there's just more sense on the boots on the ground level. I think there's more common sense. I don't think we invest in these esoteric, crazy things. And if we do, it's on us, isn't it? Isn't it our life? I mean, who knew that when you bought your house, you were being pulled in with like 6,000 other people in Kansas, that didn't have a down payment? Who knew that your mortgage was going into what they call a CDO, which was, you put 30% down, you had an income, and everybody else in that pool didn't. I mean, who knew that? I didn't.
Well, and then not only that, but on top of that, you have that bond full of all of those mortgages, and then you have like kind of fake bonds sitting on top of that just magnified the risk, just bets on top of the and it just like, if it without that, the crisis would not have been that severe, but because it was so magnified by what were purely bets, like that you would make in a casino, and they had no productive value whatsoever, that's what really brought down the economy.
The most sophisticated investor that we know, Warren Buffett, said exactly that about those instruments. He said, they're like, I think he said something, and correct me if I'm wrong, it was like 15,000 pages to an average CDO, and that no trader and no analyst and no salesperson on Wall Street ever read the 15,000, and including him. And he said, that's why I'm not going to invest in it. So this kind of brings us to the end, and I want to...
Can I say one other thing that Warren Buffett is famous for saying? Invest in what you know. It makes sense to invest in what you know, and you don't know those 15,000 pages, but you do know the great social entrepreneur that you think the world of, that's starting something that you are also really passionate about, and you know the company down the street that you are a good customer of, and they're looking to expand, and you love their business, and you know your local market, and you know that they'll do well. You know that. You don't know the CDO market.
Yeah, exactly.
Yeah, and I look forward to the chance, the opportunity that's going to give us once crowdfunding can really open up and have that kind of truly local view, because it's hard, unless you're going to go door to door or talk at every single community meeting in your entire town to attract that number of people. But if there's a great crowdfunding site that actually allows people to get together locally and tell other people about this great company and sort of share the idea and invest locally in something and get to know the person, go out to that local meeting at the grocery store or wherever the person is talking, right, and have just that moment of like chatting about, here's my health food, this is what it looks like, here's what it tastes like, here are the places where it's currently at. Folks can get excited about that. So to wrap up in the end, I'd love for you guys, because we have 3 minutes, I'd love for you each to say, absolutely, just 1 second.
Okay.
I'd love for you each to give like your 2 or 3 points, like takeaways from this that you want people to take away of what this means for the people in the audience, and then we'll shift back over to Monika, and she can have her final words. I would rather have them
close it because they're so inspirational. Would that be okay? I just wanted to say before we go that Sang's platform is called returnonchange.com, and it'll be on That Matters on Facebook. And I wanted to also say that Amy's book, Local Investing, will also be there. But she also has a blog spot, and she writes articles for the Times. All of this information and how you guys can get involved directly will be on facebook.com/thatmatters. So, ladies first, can I have you guys just tell us, like, because the question was, what do you think the future is? You can answer that, or you can answer anything you want. Just close out and tell us where we're going from now and what we can look forward to.
I think that, there's a lot of controversy swirling around crowdfunding right now, but, eventually the dust will settle, and I think what we're witnessing right now is the birth of a really revolutionary, transformative new financial system that will work for real people, and it's an alternative to Wall Street. And I love when crowdfunding is dismissed by venture capitalists and people on Wall Street as, for the little guys, and it's only $1 million. No one's ever gonna do that. Well, it's the classic innovator's dilemma, right? It's how the PC ate the mainframe and the smartphone is eating the PC. And I think that, crowdfunding is just so powerful and so scalable, and we're not even in crowdfunding 1.0 yet, right? We're still feeling our way. And yes, there will be kinks. Yes, there will be fraud, and yes, there will be blow-ups, but, let's not blow them out of proportion, right? These things happen in the stock market. They happen, people always love to, there was a piece in the Times the other day that singled out, a Kickstarter successful campaign that didn't deliver on its game. It's the NSA.
It is! NSA! There they are! NSA.
It's actually Homeland Security. They're in the building.
All right.
Yeah, 9th floor. Yeah, 9th floor.
They are? Oh,
Yeah.
Well, I feel safer.
But anyway, rather than single out that one, and there are probably more than one, there's a handful of them, of high-profile, or not even high-profile, but Kickstarter campaigns, and again, these were donations and rewards-based, that didn't deliver. What about the thousands that did deliver? And, because of Kickstarter, these ventures were able to come to life, and they might have never made it through the industry gatekeepers. In fact, Pebble Watch, which raised $10 million on Kickstarter, had been turned down by VC after VC. And, it took Kickstarter and 69,000 people who thought, wow, that's a cool watch. I want to pay for that in advance. And by the way, they've all been delivered.
Which one?
Pebble Watch.
Oh, Pebble Watch.
And since then, a venture capital firm has invested $15 million in the Pebble Watch. So all I'm saying is, be prudent, but do not be scared. This is a really wonderful thing. I am super excited about it. I love Sang's company, and I so look forward to seeing the flowering of all these alternatives that will really democratize finance for investors and entrepreneurs.
Awesome.
I just have to echo everything that Amy just said. It's a really exciting time. There is a certain amount of trepidation, but if you are well-versed, if you Google a lot, you'll learn a lot. The other thing that I have to say is that don't do it yet. It's not allowed.
It's not legal.
Please don't do it, because we'll have to deal with that too then. And there's a quote that I love to use every time I talk about crowdfunding. All great truths begin as blasphemies. And George Bernard Shaw. It's one of my favorite quotes. Every time somebody says it's never going to work, I know how big it's going to be.
Yeah, awesome. That's great. You want to close it out, Shane?
Guys, it's always a pleasure working with Monika. And Monika, your hat is amazing.
Go Red Sox!
I know.
Sorry.
Oh.
No, I have to wear the Yankees hat and say go get Red Sox. And you know who's really happy today? The Mets fans. Okay, they're really happy.
Yeah, that's true. They will.
I saw on Facebook someone said that that the Red Sox are now going back to their day jobs driving horse and buggy carts in Amish country.
So guys, check us out at facebook.com/thatmatters, or you can go to good-b.com and see all kinds of write-ups on this. We'll have lots of postings on Facebook about what we've been doing, where you can find us on YouTube and the archive for this. Most importantly, tell your friends about it if they're interested in discussing and exploring sort of the people on the ground and what crowdfunding really means. this is where it's at, and you can find out lots more. There'll be a cool Storify that I'll continue to build for the next day or so, pulling out tweets that I think are important, other people talking about crowdfunding. That's already built, and it's on Facebook, so check that out. Thanks again both to you, Sang, and to you, Amy. You're fantastic guests, and I love having you on the show.
Yeah,
Thank you.
Thank
Love
you.
being
Thanks for
here.
having us.
Questions, appreciate it. Sorry if we didn't get to everybody.
And happy Halloween.
Yeah, happy
Happy
Halloween.
Halloween.
Remember your costume. All right. Thanks.
All right.
Reward space that didn't deliver. What about the thousands that did deliver? And because of Kickstarter, these ventures were able to come to life, and they might have never made it through the industry gatekeepers. In fact, Pebble Watch, which raised $10 million on Kickstarter, had been turned down by VC after VC. And it took Kickstarter and 69,000 people who thought, wow, that's a cool watch, I want to pay for that in advance. And by the way, they've all been delivered.
Which one?
Pebble Watch.
Oh, Pebble Watch.
And since then, a venture capital firm has invested $15 million in the Pebble Watch. So all I'm saying is be prudent, but do not be scared. This is a really wonderful thing. I am super excited about it. I love Sang's company, and I so look forward to seeing the flowering of all these alternatives that will really democratize finance for investors and entrepreneurs.
Awesome.
I just have to echo everything that Amy just said. It's a really exciting time. There is a certain amount of trepidation, but if you are well versed, if you Google a lot, you'll learn a lot. The other thing that I have to say is that don't do it yet. It's not allowed.
It's not legal?
Please don't do it, because we'll have to deal with that too then. And there's a quote that I love to use every time I talk about crowdfunding. All great truths begin as blasphemies. George Bernard Shaw. It's one of my favorite quotes. Every time somebody says it's never going to work, I know how big it's going to be.
Yeah, awesome. That's great. You want to close it out, Shane?
Guys, it's always a pleasure working with Monika. And Monika, your hat is amazing.
Go Red Sox!
I know.
Sorry. No, I have to wear the Yankees hat and say go Red Sox. And you know who's really happy today? The Mets fans. Okay, they're really
Yeah, that's true. They will.
I saw on Facebook someone said that that the Red Sox are now going back to their day jobs driving horse and buggy carts in Amish country.
So guys, check us out at facebook.com/ThatMatters, or you can go to good-b.com and see all kinds of write-ups on this. We'll have lots of postings on Facebook about what we've been doing, where you can find us on YouTube and the archive for this. Most importantly, tell your friends about it if they're interested in discussing and exploring sort of the people on the ground and what crowdfunding really means. This is where it's at, and you can find out lots more. There'll be a cool Storify that I'll continue to build for the next day or so, pulling out tweets that I think are important, other people talking about crowdfunding. That's already built, and it's on Facebook, so check that out. Thanks again both to you, Sang, and to you, Amy. You're fantastic guests, and I love having you on the show.
Yeah,
Thank you.
Thank
Love
you.
being
Thanks for
here.
having us.
Questions, appreciate it. Sorry if we didn't get to everybody.
And happy Halloween.
Yeah, happy
Happy
Halloween.
Halloween.
Remember your costume. All right. Thanks.
All right.